Planning for retirement can feel overwhelming, but it doesn't have to. Taking control of your financial future starts with understanding the tools available to you. Two of the most popular and powerful tools for retirement savings are the Roth IRA and the traditional IRA. They are designed to help your money grow over time with significant tax advantages. But with different rules and benefits, deciding which one is right for your specific situation can be confusing. Let's break down the key differences and help you figure out the best path forward on Logic 360. First, what exactly is an IRA? IRA stands for Individual Retirement Arrangement. Think of it as a special investment account specifically designed for retirement savings, offering unique tax benefits that regular investment accounts don't. These tax advantages are crucial because they allow your investments to potentially grow more aggressively over the long term compared to taxable accounts. The main difference between a Roth and a traditional IRA boils down to when you receive that tax benefit. Do you want the tax break now while you're contributing, or do you want your withdrawals to be tax-free in retirement? That fundamental question is at the heart of the Roth versus traditional decision. Let's start by taking a closer look at the traditional IRA. With a traditional IRA, the contributions you make are often tax-deductible in the year you make them. This means you can potentially reduce your taxable income for the current year, which could lower your tax bill right now. For example, if you contribute the maximum amount and qualify for the deduction, that amount is subtracted from your gross income before calculating your taxes. This upfront tax break can be very appealing, especially if you are currently in a higher tax bracket. Your money inside a traditional IRA grows tax-deferred. This means you don't pay taxes each year on the dividends, interest, or capital gains your investments earn. The taxes are postponed until you start withdrawing the money in retirement. When you do begin taking qualified withdrawals in retirement, those withdrawals are taxed as ordinary income. This structure is often most beneficial for individuals who anticipate being in a lower tax bracket during their retirement years than they are during their peak earning years. Now, let's explore the Roth IRA. This option works differently regarding taxes. Your contributions to a Roth IRA are made with money you've already paid taxes on. They are not tax-deductible in the year you contribute. You don't get an upfront tax break with a Roth IRA. However, the significant advantage comes later. Your money grows completely tax-free, and qualified withdrawals in retirement are also 100% tax-free. This means that all the investment growth and earnings you accumulate over decades can be withdrawn without owing a single dollar in federal income tax, provided you meet the requirements for qualified withdrawals. This is incredibly powerful for long-term wealth building. The Roth IRA is often a fantastic choice for those who expect to be in a higher tax bracket in retirement than they are currently. By paying taxes on the money now, when your tax rate might be lower, you lock in tax-free growth and withdrawals when your tax rate might otherwise be higher. It's also appealing to anyone who simply values the certainty of tax-free income in retirement, regardless of future tax rates. Knowing that a portion of your retirement income will be completely tax-free provides great peace of mind and simplifies future tax planning. So, how do you decide which IRA is the right fit for your financial journey? It really comes down to comparing their features and considering your personal circumstances and expectations about future tax rates. Let's look at the key comparison points. The first is the tax treatment of contributions. Traditional offers a potential tax deduction now, while Roth contributions are made with after-tax money. Next, consider the tax treatment of withdrawals in retirement. Traditional IRA withdrawals are typically taxed as ordinary income, while qualified Roth IRA withdrawals are completely tax-free. This is often the most significant factor in the decision. Income limits are another important difference. There are income limitations that can affect your ability to contribute directly to a Roth IRA, or that can phase out the deductibility of traditional IRA contributions if you are covered by a retirement plan at work. Traditional IRAs generally don't have income limits for contributions themselves, though the tax benefit might be affected. Required minimum distributions, or RMDs, are also different. With a traditional IRA, you are generally required to start taking taxable withdrawals once you reach a certain age, regardless of whether you need the money. The original owner of a Roth IRA is not subject to RMDs during their lifetime, offering more flexibility in managing your assets later in life. Finally, consider flexibility. With a Roth IRA, you can withdraw your contributions, but not earnings, at any time, for any reason, without taxes or penalties. This can offer a layer of flexibility, though it's generally best to leave retirement savings untouched. Traditional IRA withdrawals before retirement typically incur taxes and penalties, with limited exceptions. Ultimately, the choice often hinges on your current tax bracket versus your expected tax bracket in retirement. If you believe your tax rate will be lower in retirement, the upfront deduction of a traditional IRA might be more advantageous. If you believe your tax rate will be higher in retirement, or if you simply prefer tax-free income later, the Roth IRA is likely the better choice. Remember, both types of IRAs have annual contribution limits set by the IRS. For 2024, the limit is $7,000 with an additional $1,000 catch-up contribution allowed if you are age 50 or older, bringing the total to $8,000. These limits can change year to year. Understanding these basics is a powerful first step towards building a secure financial future. Choosing the right IRA, or even utilizing both if your situation allows, can significantly impact your long-term wealth accumulation and retirement income. While this guide provides a solid foundation, personal finance is, well, personal. Your unique income, tax situation, age, and retirement goals all play a role. It's always wise to consult with a qualified financial advisor who can provide personalized advice tailored to your specific circumstances. Taking action today, whether it's opening an IRA or simply learning more, puts you in control. Don't let the options overwhelm you, let them empower you. If this guide helped clarify the differences between Roth and traditional IRAs for you, please hit that like button. Subscribe to Logic 360 for more financial literacy and investment guidance, and share this video with anyone you know who is planning for their retirement. Your future self will thank you.